Have you ever noticed how movie tickets or your favorite meal seem to cost more each year? That's inflation sneaking into your wallet. Inflation affects everyone, but understanding it can help you manage your money better. Here, we'll explore what causes inflation, how it's measured, and how it impacts your daily life. So, let's start with the basics. What is inflation? Simply put, inflation is when the prices of goods and services go up over time. This means that the money you have today won't be able to buy as much stuff in the future. For example, if a candy bar costs $1 today, and there's 5% inflation, next year that same candy bar might cost $1.05. Now, maybe that doesn't seem like much, but it adds up over time. So then, you might be wondering why prices go up. There are a few reasons for this. One big reason is demand. When lots of people want to buy the same thing, businesses can charge more for it. Another reason is supply. If there's less of something available, it becomes more valuable and prices go up. And then there's the cost of production. If it costs more to make something, businesses will usually raise their prices to make up for it. But inflation isn't all bad, though. In fact, a little bit of inflation is actually good for the economy. It encourages people to spend and invest their money instead of just holding on to it. This keeps businesses growing and helps create jobs. But too much inflation can be a problem. When prices go up too quickly, it can be hard for people to keep up. Their money doesn't stretch as far, and it can cause a lot of economic instability. Now, let's talk about how inflation is measured. The most common way to measure inflation is with something called the Consumer Price Index, or CPI. The CPI looks at the prices of a basket of goods and services that a typical household might buy, like food, clothing, and transportation. By tracking how the prices of these items change over time, economists can get a pretty good idea of how much inflation is happening. But inflation doesn't affect everyone the same way. For example, if you're on a fixed income like a pension or Social Security, rising prices can really hurt. You have the same amount of money coming in, but it's not buying as much as it used to. On the other hand, if you have investments like stocks or real estate, inflation can actually help you out. That's because the value of your investments might go up along with prices. So then, what causes inflation to get out of control? Well, there are a few things that can cause this. One is something called demand pull inflation. This happens when there's too much money chasing too few goods. You can think of it like a bidding war. If lots of people want to buy the same thing, they're willing to pay more for it and prices go up. Another cause is cost push inflation. This happens when the cost of making goods goes up and businesses pass those costs onto consumers in the form of higher prices. Another major factor is when governments print too much money. When there's more money in the economy, people have more to spend, but if the amount of goods and services doesn't increase at the same rate, it leads to higher prices. This is often referred to as monetary inflation. It's like if everyone suddenly had twice as much money, but there were still the same number of candy bars. Prices would go up because everyone would be willing to pay more. Speaking of which, governments and central banks play a big role in controlling inflation. One of the main tools they use is interest rates. When interest rates are low, it's cheaper to borrow money, which can lead to more spending and higher inflation. When interest rates are high, it's more expensive to borrow money, which can slow down spending and help keep inflation in check. Central banks, like the Federal Reserve in the United States, are always keeping an eye on inflation and adjusting interest rates to try to keep it at a healthy level. But inflation isn't just something that happens in the United States. It's a global issue, and different countries have different levels of inflation, and this can affect things like exchange rates and international trade. For example, if one country has much higher inflation than another, its currency might lose value compared to the other country's currency. This can make imports more expensive and exports cheaper, which can have a big impact on the economy. So, how does inflation affect you personally? Well, when prices go up, you need more money to buy the same things. This can be especially tough if your income isn't keeping up with inflation. For example, if you're saving up for something big like a car or college tuition, inflation can make it harder to reach your goal. That's why it's important to think about inflation when you're planning your finances. One way to protect yourself from inflation is to invest your money. Investments like stocks, real estate, and even some types of bonds can go up in value over time, helping to offset the effects of inflation. Another way is to look for ways to increase your income. This could mean asking for a raise, getting a higher paying job, or starting a side hustle. The key is to make sure your money is working for you so you're not falling behind as prices go up. And then also, inflation can also affect your savings. If you just keep your money in a regular savings account, the interest you earn might not be enough to keep up with inflation. That's why it's important to look for savings options that offer higher returns, like high-yield savings accounts or certificates of deposit or CDs. These can help your savings grow faster and keep up with rising prices. Another thing to keep in mind is that inflation can affect your debts. If you have a fixed-rate loan, like a mortgage or a car loan, inflation can actually work in your favor. That's because the amount you owe stays the same, but the value of the money you're paying it back with goes down. On the other hand, if you have a variable rate loan, like some credit cards or student loans, inflation can make your payments go up. That's why it's important to understand the terms of your loans and how they might be affected by inflation. So, what else can you do to stay ahead of inflation? One thing is to keep an eye on prices. If you notice that the cost of something you buy regularly is going up, it might be a sign that inflation is on the rise. Another thing is to make a budget and stick to it. By keeping track of your spending and looking for ways to save, you can make sure you're not caught off guard by rising prices. It's also a good idea to stay informed about what's going on in the economy. Pay attention to news about inflation and interest rates, and think about how they might affect you. And don't be afraid to ask questions. If you're not sure about something like how inflation might affect your investments or your savings, talk to a financial advisor or do some research online. So, as you can see, inflation is a normal part of the economy, but it can have a big impact on your finances. By understanding what causes inflation and how it's measured, you can be better prepared to deal with rising prices. And by taking steps to protect yourself, like investing your money and keeping an eye on your budget, you can make sure you're not falling behind.